Amazon is a juggernaut of the Mag 7 tech stocks with a market cap of close to $2 trillion, and the stock is up 43% in the last year. It's making a massive push into AI and leveraging its rapidly growing cloud business, AWS. So, is now the time to buy this tech superstar? Let's dive in and find out. All right, 3 points that we are going to cover in this video. Number one, background/business model. The company has 4 segments: advertising and subscriptions, think of Amazon Prime; AWS or Amazon Web Services, think of the cloud; third-party sellers, Amazon FBA; and then online and physical stores, think of Whole Foods, and then when you place orders on the Amazon app. Part 2, company update, positives and negatives. So the company reported solid 2Q24 results. I've isolated the key highlights just for you. Also, I'm going to provide a major update with AI and what the company is doing in that space. Lastly, part 3, the valuation. On Wall Street, we build 3-statement financial models culminating in a discounted cash flow or DCF valuation. I have built a 3-statement model and think that Amazon has some upside potential and can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. All right, first company background. I think we all know the story about Amazon. 1994, Jeff Bezos is sitting in a garage packing books. Who would have thought that today it would be the company that it currently is? I order from Amazon on the regular, and I know you probably do too. So Amazon has expanded to sell everything: electronics, clothing, groceries, and much, much more. They're a global giant. They're the go-to platform for online shopping, but it's also a major player in cloud computing with Amazon Web Services or AWS. Also with Prime, it has expanded into entertainment and streaming video and music. But the real magic behind Amazon isn't just what they sell. It's how they've mastered making money in ways you might not expect. And that's what's coming up next. All right, business model. So how do they make money? Have you ever clicked buy now on Amazon and wondered how they make money so easily? While we might be getting stuff on the regular from Amazon, the money-making machine goes way beyond selling stuff. The real secret behind Amazon's billions is actually hidden in plain sight. So the way that I'm going to do this is tell you about what the business was like 5 years ago versus today as it pertains to the 4 core segments. So 5 years ago, 60% of revenues, today 40% of revenues, online and physical stores. So Amazon makes money directly by selling items to customers, either via Whole Foods or the Amazon app. 5 years ago, 18% of revenues, today 24% of revenues, third-party sellers. So they also earn fees from third-party sellers using their platform, Amazon FBA. 6% 5 years ago, 15% today. That is subscription and advertising. So Amazon Prime generates billions from memberships. Customers pay for perks like free shipping and streaming, keeping them coming back. Also, Amazon's website and apps are prime real estate for advertisers. They earn money by showing ads to shoppers, driving product sales. And then last, but certainly not least, 5 years ago, 11% of revenues, today 16% of revenues, Amazon Web Services or AWS. So this is the cloud. AWS is the backbone of the internet. From streaming services to apps, AWS powers companies worldwide and makes up a large part of Amazon's profits. So big takeaway here, Amazon's business is shifting from physical goods to services. So it's a major theme that we see with this company. All right, latest company updates, 2Q24 financial results. Amazon second quarter 24 results are in the books. What is the headline? So a surge in revenue, but with some surprises that could impact the company's future. So what did Amazon do well? Where did they stumble? Let's take a closer look. Revenue growth. Amazon's net sales increased by 10%, reaching $148 billion, with strong 11% growth when you remove the impact of currency fluctuations. So Amazon's core business is growing steadily, showing that customers are still shopping despite economic concerns. Amazon's expanding globally, and its ability to maintain double-digit growth highlights its resilience. North America and international sales. So North America sales increased by 9%, while international sales grew by 7% or 10% when adjusting for currency. So Amazon's strength in North America is consistent, but the real story is international markets. This is where the company's making incredible strides despite challenges in foreign currencies. Now, this suggests Amazon's potential for growth is way beyond the US. Amazon Web Services. So AWS saw a 19% rise in sales, reaching $26.3 billion. AWS remains a key driver of Amazon's overall profitability. We're going to discuss this later. Also, AWS's rebound is critical because it represents Amazon's leadership in the cloud space. The push towards AI is driving demand for AWS services, which positions Amazon well in the booming AI industry. This is a key area for future growth, and we're going to discuss this in detail next with our AI update. Operating income. So Amazon's operating income doubled to $14.7 billion with strong performance across North America, international, and the AWS segments. Operating income growth tells us that Amazon isn't just increasing sales, it's becoming more efficient, cutting costs, and boosting profitability. This is a strong sign for investors who want to see more profit, not just revenue growth. Net income. So Amazon's net income also doubled to $13.5 billion or $1.26 per share, with help from a $400 million gain from their investment in Rivian. Now, doubling profits is always a positive sign, but the fact that Amazon is seeing this kind of growth during uncertain times speaks to its strong management and diverse business. Investors should be encouraged by Amazon's ability to deliver profit on multiple fronts. Cash flow, let's face it, cash is king. So operating cash flow jumped 75% to $108 billion, with free cash flow growing to $53 billion, a dramatic increase from the previous year. So Amazon's cash flow surge shows us that the company is generating more money than it's spending, which is a strong indicator of financial health. This gives Amazon more flexibility to invest in new technologies, acquisitions, or further expand its operations. Now, with AWS bouncing back and strong cash flow, it seems like Amazon's future is bright, but there's more to the story and there's still some challenges that Amazon's going to need to overcome. We're going to cover some of those next. So imagine a world where Alexa knows exactly what you want before you even ask, or where your favorite shopping site predicts the perfect item for you at the right time. Well, that's the future that Amazon is working towards, and Amazon has been making multi-billion-dollar investments in AI. But why is this year so critical, and what steps has Amazon taken to solidify its place in the AI race? So January 2024, at the start of the year, Amazon announced it would be investing $10 billion into AI research and development over the next 3 years. This is part of a broader effort to compete with companies like Microsoft and Google in the AI space. Amazon Bedrock was launched in mid-2024. This is a service through AWS that allows developers to use pre-trained AI models. This makes it easier for companies to integrate generative AI into their own applications, from chatbots to AI-driven analytics. Partnership with Hugging Face. So in a landmark deal, Amazon partnered with Hugging Face, one of the leaders in NLP, or natural language processing, to offer state-of-the-art AI models through AWS. This partnership gives developers access to cutting-edge tools and building AI advanced applications. Generative AI in Alexa. In 2024, Amazon revealed that Alexa would become even more advanced, using generative AI to create more human-like conversations and better understand context. So imagine Alexa not just answering basic questions, but engaging in a detailed, helpful discussion. AI-powered shopping. Amazon is integrating AI into its shopping experience. From personalized recommendations to dynamic pricing models, Amazon uses AI to predict what you might want to buy next, improving customer satisfaction and increasing sales. AI in warehousing and logistics. So Amazon has deployed AI-powered robots in several new warehouses. These robots can move items faster and more accurately, cutting down delivery times.
Agility Robotics is funded in part by Amazon, which is investing $1 billion in new industrial technology.
But here's the big question. Can Amazon's aggressive push into AI help it outpace tech giants like Microsoft, Google, and others? With the advances that they're making, especially in logistics and AWS, it looks like Amazon's future is more automated than ever, and investors are paying attention. Positives and negatives. I like to hear the bad news first. Let's cover the negatives. Amazon may seem unstoppable, but even the strongest companies face challenges. Whether it's fierce competition or slowing growth, Amazon has a few hurdles to overcome. Could these issues threaten its long-term success? So, AWS growth is slowing. Now, while you might be concerned, you do need to understand there are some positives here. So while it's showing signs of slower growth that could hurt profitability, AWS is the crown jewel of this company. Now, while AWS is only 16% of total revenues, it is 67% of the operating profit, with margins around 27%. Just to give us some perspective, for every dollar generated by the other 84% of the business, non-AWS, only 3 cents of profit is generated. For every dollar generated by AWS, 27 cents of profit is generated. That is 9 times higher, and this is why AWS is so valuable to Amazon. Increased competition. So competitors like Walmart and Microsoft are catching up in e-commerce and cloud computing. They're challenging Amazon's dominance. High operating costs. Amazon's costs are rising, which could eat into profits, especially as they continue to expand. Stock volatility. Amazon stock has been more volatile recently, with concerns over slowing growth and economic uncertainty. So should you be worried about these risks? Well, every company has challenges, but Amazon's strengths may far outweigh the negatives. So now let's look at the positives. When you think of Amazon, you probably think of convenience. ordering anything just in a few clicks. But behind the convenience is a business strategy that makes Amazon one of the strongest companies in the world. So why do so many investors love this stock? First, strong brand recognition. Amazon is trusted globally and dominates e-commerce. Diverse revenue streams. So from e-commerce and AWS to ads and subscriptions, Amazon has multiple ways of making money, thus reducing risk. Prime membership loyalty. So there's over 200 million Prime members, which keep Amazon's e-commerce engine running. I'm one of them, and I love it. Ad business boom. So Amazon's ad business is growing fast, offering a new stream of revenue that boosts profits. We're going to see this next in the valuation. Lastly, innovation in AI and logistics. We mentioned this earlier, but Amazon's investments in AI and its logistics network set it apart from competitors. So how do we put this all together? That's what we're about to cover next. The valuation, we're going to begin with the balance sheet. So the company has tons of cash, almost $90 billion. It's doubled in the last 5 years. Now, while debt has also doubled in the last 5 years, the company has very low leverage. Debt is only 3% of total capital, and they've been net cash for the last 7 years. That means that their cash is greater than their debt, which provides a ton of financial flexibility. They control 650,000 square feet of real estate, which is up from 290,000 5 years ago. That means they've doubled their real estate footprint for all of their fulfillment. Also, we've seen a 6x increase in retained earnings over the last 5 years. So understand that that is super impressive because they've been investing heavily in fulfillment and the cloud, which we're going to see next in the income statement. So what's the takeaway? The company is very conservatively financed. It's net cash. It has a solid balance sheet and a AA credit rating. Let's hop in the model. All right, y'all, balance sheet, check this out. Massive amounts of cash. It's only been increasing over the last 5 years and will continue to increase in the future. Debt, although it has doubled, it's very much under control by the company. And we mentioned that they're net cash. Lastly, retained earnings. You see a massive ramp up in retained earnings, about 4x over the last several years. This is a sign of tremendous positivity. All right, next we have the income statement. So revenue has grown 2.5 times in the last 5 years, while net income has grown 3 times. This is phenomenal and shows cost control and positive operating leverage. Remember, revenue is what you make and net income is what you keep. Gross margin is up 10% and net margin has tripled in the last 7 years. That shows incredible cost control. Now, the company has made big investments in fulfillment technology and infrastructure to the tune of $130 billion in 2023. Now, we do have to mention they got hammered by their investment in Rivian in 2022, so that equity investment lost $12.7 billion. Now, they are reinvesting in the business. We're going to see this later on in the cash flow statement. So what's the takeaway? The company is growing responsibly with revenue growth outpacing costs. They have positive operating leverage, and they have a 5-year return on invested capital of 12% and a return on equity of 16%. Let's hop in the model. All right, lots of positives here with the income statement. We see a 2.5x increase in top line growth. We also see a massive investment in fulfillment and technology and infrastructure. I mentioned the unfortunate loss from Rivian in 2022. They've obviously overcome that in 2023. And then lastly, net income has increased at a greater rate than revenues. This shows phenomenal positive operating leverage. All right, next we have the cash flow statement. So free cash flow has nearly doubled in the last 5 years, while operating cash flow has nearly tripled. Now, a few other important things to mention here. Unlike other tech companies, they're reinvesting more into the business than they're returning to shareholders. So over the last 5 years, they've made $21 billion of acquisitions, and they've spent $234 billion on CapEx. That's about $255 billion total. That's 40x more than they've returned to shareholders, which amounts to $6 billion. Now, they're also making tons of money off of their invested cash. They've generated $170 billion of positive cash flow over the last 5 years just from their invested cash. Now, cash is set to 4x over the next 5 years if their trend continues. And they're projected to invest over $400 billion in capital expenditures over the next 5 years. Let's hop in the model. All right, a few key takeaways here. Positive operating cash flow, positive free cash flow, phenomenal. Also, as I mentioned, they've been investing a ton of their cash. They've been generating a ton from that, $170 billion over the last 5 years. This helps them to fund acquisitions, and they're reinvesting in the business. Lastly, I mentioned share repurchases, only $6 billion returned to shareholders, which is not that much Why? Because they've been reinvesting in the business. This is something that Amazon's been known for the last 2 decades. And then last but certainly not least, cash is supposed to 4x over the next 5 years. This is a massive positive for investors. All right, next we have forecast drivers and DCF assumptions. So the company has shown incredible cost control despite having very high revenue growth. Cost of goods sold and overhead went from 61.2% to 55.4% over the last 5 years. That means they've shaved off 6%. Now, to put that in perspective, that's a savings of $35 billion. They've repaid $132 billion of debt over the last 5 years, with another $28 billion over the next 5 years. They have a pretty moderate beta for a tech firm of only 1.2 and a moderate WACC, or weighted average cost of capital, of 8.2%. They have low leverage, only 3%, and a AA credit rating. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. All right, a few things to note here. We see with the cost of goods sold, they've shaved 6%. I mentioned that's a massive savings of $35 billion. Another thing to mention in terms of operating costs, G&A, which is overhead, has remained flat. That means that they're not hiring too many people or overpaying their current employees. A few things to note on the DCF assumptions. So the risk-free rate has come down. That's tremendous. We know that the Fed has reduced rates 50 basis points over the last several weeks. So that's a tremendous positive for the weighted average cost of capital. They have a AA credit rating, which is excellent. They have very low leverage, only 3%. They also have a massive stockpile of cash, almost $90 billion. The one other thing that I do want to touch upon is the terminal multiple. This is going to be the bulk of the value of the company from the end of the model out into infinity. So if we open up the note here, one of the things that we see is based on their competitors, they have about a 19.2x TEV to EBITDA. But Amazon's multiple is below that. So should we be concerned? Right now, I think Amazon is a little bit undervalued on a relative basis. And when we look at their historical multiples over the last 12 quarters or 8 quarters from a TEV to EBITDA perspective, we get about 20 times. So I'm actually very comfortable with using this multiple. All right, next we have the DCF, or discounted cash flow valuation. We ran 3 scenarios, bear, base, and bull, with the current model at base. So future cash flows are discounted back to today to get to TEV, or total enterprise value. We strip out net debt to get to equity value. So the company is high growth, has lots of cash, big investments, and a huge push into AI. But is it worth buying today? The stock is up over 43% over the last year and 23.5% year to date. Wall Street has Amazon at an average of $220 per share, which is a 19% discount. But what does our analysis show? Let's hop in the model. All right, DCF valuation time. Woo woo. So we've got EBITDA less DNA. That gives us EBIT. We strip out the cash taxes, we get to EBIT or NOPAT. We add back the DNA. We take into account changes in operating working capital. We strip out the CapEx. We get FCFF, free cash flow to the firm. We then have to take into account our terminal value. Remember, that's 20 times our terminal EBITDA. We get our cash flows to discount. We discount them back to today to get our present value of free cash flows. We then come to our total enterprise value, about $2.43 trillion. We strip out the debt. We add the cash. We strip out non-controlling interest. We add associate investments. We get a value of about $2.46 trillion for the equity. Pretty phenomenal. We take into account the shares outstanding. We get an implied share price of $234. That's compared to $185 at the recent close. That is a 26.4% discount, which is a screaming buy. All right, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and WACC versus the terminal multiple. 0 out of 50, or 0%, showed a sell rating. 12 out of 50, or 24%, showed a hold rating. 38 out of 50, or 76%, showed a buy rating. Now, we ran each of the 3 scenarios equally weighted. We got a weighted average value of $236. That is a 27% discount. So what's the takeaway? Utilizing conservative assumptions, we show a buy rating for the stock at a significant discount. Let's hop in the model. All right, so we look at the data tables right here. We can see green everywhere. Happy St. Patrick's Day, money, money, money. We only see a few instances of a hold rating, so the vast majority of these show a buy. All right, moving on to the scenario analysis, we have our bear, base, and bull case. So the bear case is a downside that shows a sell rating. The base case and the bull case both show significant upside and both show a buy rating. On the net, we equally weight each. We get about $236 per share, which is a 27% discount. On Wall Street, anytime we have greater than a 20% discount, that is a buy rating. All right, the wrap up. So Wall Street has Amazon at a high of $265, which is a 43% discount, an average of $220, which is a 19% discount, and a low of $180, which is actually a 3% premium. So our analysis showed Amazon at a value of around $234, which is a 26% discount. So what has changed? Because this model is an update of my previous model that I did in April. So I want to do a little side by side. So first off, the price when we did this in April was 183.32. At today's close, it's 185.13. So there's only a 1% increase in price. So how do we have such a significant difference in terms of the rating from April to today? So the revenue growth went from 12% in the old model to 11% in the new model. This is in line with recent results and Wall Street consensus. Also, cost of goods sold, I think it was a little draconian previously. It was at 55% of sales. I moved it down to 51% of sales. And actually, if you look at the first 6 months of the year, it's only 50.3%. So this is totally in line. Also, the weighted average cost of capital went from 9.5% to 8.2%. This was ultimately because the Fed lowered rates 50 basis points over the last few weeks. So this actually had a significant positive impact for the overall valuation. Lastly, when we ran our last model, we got a value of 175. This time we got a range of 234 to 236. So last time we showed a premium of about 4%. This time we show a discount of approximately 27%. So it's a significantly different scenario and result. Now, you should seek the advice of an investment professional always. I do not know your individual financial situation, and ultimately, this content is meant to educate. It's not investment advice. That being said, I do have a position in Amazon at an average price of $175 per share. I will be looking to add to it opportunistically around the average price. Now, a few things to be aware of here. October is particularly dicey month for stocks. The Great Depression in 1929, Black Monday in 1987, the global financial crisis in 2008, all began in October. Also, volatility is 34% higher in October than non-October months. So why do I say this? This volatility could provide buying opportunities, not just for Amazon, so keep your eyes peeled. With almost $90 billion in cash, a AA credit rating, and hundreds of billions of CapEx allocated, Amazon has big plans for AI, and I'm excited to see what they do. If you like this and want to see another stock valuation, check out my CrowdStrike model here or my Rocket Lab model here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.